Chapter 5 Banking Law and Practice. Part 1. Innovation in Banking, Meaning and Need. Meaning: innovation means doing something new, something that wasn't done before. In banking, it means moving away from old traditional methods and adopting better, modern ways. Why innovate? The world was changing too fast. Banks could no longer evolve in timid steps. They needed bold changes delivered in months or even weeks. COVID-19 push. The pandemic forced banks to act fast and focus on human needs, not just profits, delivering major innovations in record time. New models needed. Banks had to build new business models, partner in unconventional ways, rediscover their purpose, and commit to constant innovation. Purpose-driven banking. Banks started innovating not just for cost savings, but to create real benefits for themselves, their customers, and society as a whole. For key trends of banking innovation. Purposeful relationships. Banks worked past customers' nostalgia for old ways and partnered with them to build a new, better normal after the pandemic. Listening at scale. Banks use technology to listen to large numbers of customers at once and respond with personalized service, impossible in traditional banking. Digital with a human touch. Banks developed creative tools to bring warmth, empathy, and real support into digital interactions, so customers didn't feel left out. Building a sustainable future. A major theme, banks actively started supporting the shift towards a more environmentally and socially sustainable world. Core banking, meaning. What is core banking? Core stands for Centralized Online Real-Time Exchange. It is a banking service provided to customers in electronic form, introduced after computerization of banks. Word breakdown. Centralized equals all data stored in one main server. Online equals works through the internet. Real-time equals transactions happen instantly without any delay. How it works. All branch computers across the country are connected to a central server. A customer can access their account from any branch in India or the world. Popular platforms. Software from Infosys, Finacle, TCS, BCU, and iFlex, FlexiCube became the most widely used core banking platforms in Indian banks. Example: your account is in a Mumbai branch, but you can withdraw money and check your balance from a Delhi branch. That is core banking. Core banking, software and features. How it runs. Special software is installed on all branch computers and connected through the internet, forming one unified national banking platform. Transaction recording. Every deposit, withdrawal, or transfer is recorded in real time on the central server. Passbook maintenance. The software automatically keeps a running record of all deposits, withdrawals, and account balances. Interest calculation. Interest on loans and deposits is calculated automatically by the system, no manual calculation required. Account statements. Customers can get their account statement and check their current balance at any time from any branch. Instant balance update. After every transaction, the updated balance is immediately reflected and stored in the central system. Core banking, advantages and cost comparison. Cost reduction. Traditional banking cost Indian rupee 75 per transaction. ATM equals Indian rupee 16. Online banking equals 2 Indian rupees or less. Mobile banking equals 1 Indian rupee or less. Core banking drastically cut costs. Anywhere banking. Customers can now do banking from any part of India or the world. No need to visit their home branch at all. Faster and safer. Operations became faster, safer, and far less complicated compared to old manual banking methods. Reduced errors. Core banking reduced human error, increased accountability, and made the entire system more user-friendly for both banks and customers. Customer growth. Thanks to all these benefits, the customer base of banks grew exponentially after core banking was introduced. IDRBT, Banking Technology Research Institute. What is IDRBT? IDRBT, Institute for Development and Research in Banking Technology, was set up by RBI in 1996 in Hyderabad to design and develop IT solutions for Indian banks. Research areas: financial networks, electronic payment and settlement systems, cybersecurity, cloud computing, mobile banking, and financial information systems. Academic programs: offers PG diploma in banking technology, M.Tech, and PhD programs. Also trains top and middle management banking staff in IT. IFTA's 2016, a separate unit called IFTA's, Indian Financial Technology and Allied Services, was set up in Mumbai to handle Infinite, SFMS, and Indian banking cloud programs. Innovation contests. IDRBD runs annual contests to discover new banking technologies from society. Selected products are honored and may be purchased for use in banking. E-banking, meaning. What is e-banking? E-banking, also called virtual banking, online banking, or net banking, is an electronic payment system that lets customers carry out banking transactions through their bank's website. The word EE stands for electronic, meaning all transactions happen through electronic devices and the internet without physically going to the bank. What can you do? Transactional, withdraw or deposit money, transfer funds. Non-transactional, request a checkbook, view statements, update contact details, all done online. Why it was adopted. E-banking emerged to solve the limitations of traditional banking. It offers boundaryless, faster, and more informative banking through internet tools. Example, at midnight, instead of waiting for the bank to open, you log into your bank's website and instantly transfer money to a friend. E-banking advantages. 24/7 access. Customers can access their bank account anytime, 24 hours a day, 365 days a year from anywhere without visiting the bank. Lower cost. E-banking has reduced banks' operational costs significantly, allowing them to offer services at lower prices to customers. Quick fund transfer. Customers can transfer money instantly and safely to any account through electronic fund transfer from anywhere in the world. Discounts and savings. Customers can get cash discounts and other offers when paying through debit or credit cards at retail outlets. ATM cash access. ATM facility lets customers withdraw cash at any time, 24 hours, 365 days, without needing bank staff. Business growth for banks. E-banking helps banks expand their customer base, retain existing customers, and deliver better quality services at scale. E-banking disadvantages. Security risk. Hacking of customer accounts is a serious problem. Despite protective measures, cyber fraud and unauthorized access remain major threats. High installation cost. Setting up e-banking infrastructure, internet, hardware, software, servers, is very expensive. Banks often transfer this cost to customers as service charges. Training challenge. Banks must spend heavily on IT training for employees. Running 24/7 services requires qualified, tech-savvy staff at all times. No personal contact. Face-to-face interaction with bankers is not possible. The personal touch that solves many customer problems quickly is completely missing. Tech dependency. E-banking depends on gadgets, internet speed, and network connectivity. Slow internet or device issues can frustrate users easily. Low trust. Many people, especially older generations, still do not trust or know how to use internet banking and stick to traditional methods. E-banking versus traditional banking. Key differences. Time. Traditional banking requires visiting the branch only during working hours. E-banking is available 24 hours a day, 7 days a week, from anywhere. Security. Traditional banking has low security risk. E-banking is vulnerable to hacking and cyber fraud, despite several protective measures. Cost. Traditional banking has high operating costs. E-banking has high initial setup cost, but very low ongoing operating cost. Presence. Traditional banks exist physically and customers must visit them. Internet banking has no physical presence. Everything is done online. Contact. Traditional banking allows face-to-face contact with bankers. E-banking only allows electronic contact, no personal interaction. Accessibility. Traditional banking is not accessible while traveling. E-banking can be used from any location at any time, even internationally. Telebanking, telephone banking. What is it? Telebanking is a banking service where customers call their bank on the phone and get account information without needing to visit the branch. History. First introduced in 1984 by Gyro Bank in the UK. It grew popular in the 1990s and was the first time customers could access banking over the phone. How it worked: bank computers were connected to telephone lines using a modem. Voice processing software recognized the caller's voice and provided suitable replies. Services offered: customers could inquire about account balance, check past transaction history, and get basic banking information, all over a phone call. Decline: with the rise of internet banking and mobile banking, telebanking gradually declined and is rarely used today. ATMs, meaning and services. What is an ATM? ATM stands for Automated Teller Machine. It is an electronic machine that allows customers to carry out financial transactions without any bank staff involvement. How to operate: customers insert their debit or credit card, magnetically coded, into the machine and enter their PIN, personal identification number, to proceed. Services provided: cash withdrawals, balance inquiries, bill payments, checkbook requests, and even some loan-related services, all available 24/7. Other names: ATMs are called by many names worldwide: cash machine, cash point, cash dispenser, anytime money, bancomat, mini bank, and hole in the wall. Cards used at ATMs: credit cards, debit cards, and smart cards, chip-based, are the main instruments used to operate ATMs. Types of ATMs. Set 1. Biometric ATMs use fingerprint or face recognition instead of a PIN, specially designed for illiterate customers who cannot operate a regular card. Solar energy ATMs run on solar power for rural areas with no electricity supply. They are eco-friendly, low-cost, and support financial inclusion. White label ATMs, set up, owned, and operated by non-banking finance companies, NBFCs. They are approved by RBI under the Companies Act. Brown label ATMs, hardware owned by a service provider but operated under a bank's brand name. The bank manages cash supply and network connectivity. On-site ATMs, installed inside the bank premises, convenient for customers who are already visiting the branch. Types of ATMs. Set 2. Off-site ATMs belong to a bank but placed outside its premises, found in shopping malls, airports, hospitals, educational institutions, and business areas. Online ATMs, always connected to the bank's database in real time. Account balances and withdrawal limits are monitored continuously. Offline ATMs, not connected to the bank's database, operate with a preset withdrawal limit fixed by the bank that cannot be exceeded. Standalone ATMs, not connected to any network, transactions restricted to that specific branch and its linked branches only. Networked ATMs, connected to a wide network, can be used at any location, even outside the home city or state. Color-based ATMs, green equals agriculture, orange equals share transactions, yellow equals e-commerce, pink equals women banking, brown equals service provider operated. SWIFT, International Fund Transfer Network. What is SWIFT? SWIFT, Society for Worldwide Interbank Financial Telecommunication, is a cooperative society providing a secure global network for financial messaging and fund transfers between banks. History: formed in May 1973 with 239 banks from 15 countries. Headquarters is in Brussels, Belgium. Started functioning in May 1977. India's membership: RBI, 27 public sector banks, and 8 foreign banks in India are members of SWIFT. Indian banks use the upgraded SWIFT 2 system. Services: handles transfer of messages for fixed deposits, interest payments, debit/credit statements, and foreign exchange, all at an international level. Key features: available 24/7, 365 days a year. Highly secure, protects against loss, alteration, or tampering of financial messages during transmission. Credit card and debit card. Credit card, issued by the bank and allows the customer to spend up to a fixed credit limit. The customer uses it now and repays the amount to the bank later. Debit card, linked directly to the customer's bank account. When used, money is instantly and automatically deducted from the existing account balance. Key difference: credit card equals spend first, pay later. Debit card equals money deducted immediately from your existing balance. Debit card only works if you have funds. How they work: both cards are inserted into POS, point of sale, machines at shops or into ATMs. The system reads the card and processes the transaction electronically. India's debit card system, managed by NPCI, National Payments Corporation of India, through the Rupee card. Some banks also issue Visa and Maestro debit cards. Smart card. What is a smart card? A smart card, also called chip card or integrated circuit card/ICC, is an electronic card with a built-in microchip that stores and processes data securely. Why smart? The embedded chip can think. It stores personal identification, authentication info, and payment data. Regular cards only have a magnetic stripe, no chip. How it works: it functions like an electronic purse. It holds a stored monetary value. Each time it is used, that value reduces by the amount spent. Security. The chip holds strong security features, personal identification, authentication, and asymmetric crypto protection, making it much harder to clone or hack. Recharging. When the chip value reaches 0, the customer must recharge the card before using it again, similar to topping up a prepaid mobile SIM. Internet banking, meaning and services. What is it? Internet banking, also called online banking or net banking, allows customers to access banking services through the internet from any device, anywhere, anytime. History in India. Introduced at the national level in India by RBI in 1991 through BankNet I and BankNet 2, the first major step towards digital banking in the country. Services available: e-tax payment, account balance check, online share trading, money remittance, bill payments, railway reservation, loan applications, and fund transfers. 3 types of functions: information services, product and bank info, communication services, emails, loan applications, and transactional services, fund transfer, bill payment. Key benefit: available 24/7, customers can handle all banking needs from home or while traveling without ever visiting a branch. That's part 1 done. Watch part 2 next.